Welcome to the weekly update, where I'll go over the action in the market for the week of December 9th through the 13th, and then we'll see how things look for the week of December 16th through the 20th. Okay, saw a bit of a pullback, not too much, a little bit of a disappointment if you really wanted the market to go higher. We're hearing some concerns about valuation, that the market's expensive right now, but we've been expensive for quite a while. We've been seeing this and going through this in this video as well as the intermarket analysis video. And I don't know why folks are really taking that to heart now because this has been going on for a few years. You combine that with, in the short term, we were getting a little overextended to the upside, so the market was probably due for a bit of a pullback. We were also going through a short term, about a week, period of negative seasonality that seems to have played out. Now we're potentially coming into a time of positive seasonality from now until the end of the year and then into 2025. We don't know if the market's going to stick to that, but this is historically a pretty positive time of year. We're seeing mixed signals right now on the daily charts, and I'll try to compare those as I go through the weekly charts here. But we're also seeing some things that are quite positive, even though we've been pulling back. We haven't even come down to the 20 period moving average with the S&P on the daily charts. We're seeing growth really holding up pretty well compared to value. We're seeing the mega caps. Those are the ones that really drive the indexes. They're holding up fairly well. The NASDAQ and NASDAQ 100 is doing pretty well, even though it ended up declining in Friday's session. They set new all-time highs this past week. So there are some things that are positive, but under the surface, when we look inside the S&P, there are some things that have been giving us some concerns. Okay, before I get into that, the daily videos are the real foundation of the analysis that I do. So if you've watched this weekly video from time to time or as often as you can, please feel free to check out the daily videos that I post. That's where I do the real subtle changes that we see from day to day, and that can help you as far as making decisions or evaluating where we're at with the market. There's a PDF below this video and every video that I post that shows you the slides that you see right now and the charts. And every day I update a thing called pivot points. That's on the YouTube community tab. That's built-in support and resistance areas that sometimes can be very helpful. I do have a private Facebook group, not really active, not a lot of people in there. If you want to join and change that, you're more than welcome to do that. Lately, I've been getting a lot of these social media expert comments on Rumble. I go through and I just delete those. If you have a legitimate comment, you're more than welcome to post that. And I also post on Rumble as well as YouTube. Sometimes I have some uploading problems from one platform to the other, so I use it both as kind of a backup to the other one. Also, the SPX Investing Program, it's up, it's going, at least for a few more weeks. It's completely free, it's wide open. Feel free to check that out. There's a link that'll take you to the website or to a video. You do get access immediately to the videos as they are available, where I hold those back on YouTube and Rumble. And there are additional videos that I post on the website that I don't post publicly. If you have any questions, you are more than free to send me or more than welcome to send me an email here. Also, as I mentioned before, this is the weekend, so I'm doing the outside circle of videos, except for the supplemental videos. They're all meant to tie into the daily video. Okay, let's go back and talk about what happened. For the week, we were down 0.64% on above average volume. A little bit of a concern that we were going down and we saw volume picking up. Now, I'll go through what happened each day, but we pretty much saw things in Monday and Tuesday's session going down. Then we had a kind of a big update on Wednesday. Then we went back down to declining on Thursday, and we were unchanged on Friday. We are still looking positive, though, in the bigger picture and in the longer term. The weekly charts are still looking pretty good for right now. We did get a new read on inflation, and at the consumer level, that came in as expected. We're seeing a bit of a tick up in some areas at the consumer level, but also in the producer level. That's causing a bit of a concern in the market right now. And interest rates are now going back up. And that's another reason that stocks were pressured this past week. And as I've been saying in all the videos that I do, we've got all kinds of crazy geopolitical things going on, but the market's not really paying attention to any of those for the time being. And the Fed is going to come out this upcoming week and actually probably cut rates 25 basis points. And then they'll have their statements and everything that they make after that that the market can react to. We are still positive with the trend. The green line's above the red line, and we're still trending where we've been kind of going sideways a little bit on the daily charts. We're still positive there, but we're seeing some of our other indicators that are actually turning negative. But in the bigger picture, things still look positive. So, just some bullet points here. The Nasdaq Composite, it was able to get above 20,000 throughout the week. That's never happened before. Where the S&P, the Dow, and the small caps ended up declining. And the valuation concerns, as I was talking about, we've seen that for quite a while. And you combine that with the market being overextended in the short term, and that suggests that a pullback is not really a surprise, but we're at least to right now, everything that we've been seeing to the downside is just a pullback. And the declines, as I said, appear to be, there we go. Okay, and then as interest rates did end up going up. Now, a week ago, we were at 4.15%. After Friday, we're at 4.4%. And the economic data that came out, a little bit disappointing as far as inflation. And we're seeing a little bit of softening in the labor market. So these are kind of opposite of each other. The market wants inflation to go down, and it's been going up a little bit. And the market wants at least the employment part of the economy to stay fairly strong. We're actually seeing a little bit of weakening in that area. And then CPI did meet expectations, and it pretty much reinforced the idea that the Fed is going to cut rates 25 basis points this week. But PPI showed a bit of rising inflation, where the weekly jobless claims and continuing claims actually increased. That shows more people are filing for unemployment. And just as a point of reference here, the European Central Bank ended up cutting their rates 25 basis points, but that was expected. All right, so for the week, the Dow was down 1.8%, the Nasdaq was up 0.3%, the S&P down 0.6%, and the small caps, which there's a lot of anticipation about this. We're coming into the middle part of December. Are the small caps going to perform well here? Well, they didn't this week. They were down 2.6%, but we're seeing some positive things. And watch the daily videos for that, because in the small caps and mid caps, the growth to value ratios are holding up fairly well. And that could end up being positive, even though we're not seeing that based on price for the small caps and mid caps. And we're seeing that good holding up fairly well with the S&P also. All right, this is an updated version of a chart that I've been showing for about a year and a half or so, and it compares inflation from 1966 to 1982. And since it's such a long-term chart, I don't need to update this very much, but what we're following here is what happened in the past. And that's the dark blue line where we've been coming down with inflation. The light blue line, that's what's been happening with CPI, and it's still, for the most part, continuing to go down, even though it's ticking back up right now. And even when we were going down in the mid 70s or so, this still was, the bigger picture was that it was still declining. The reason why I keep showing this chart is look at what happened after. Now, we don't know if it's going to play out that way or not. But just because inflation is coming down now doesn't mean that it's not going to go up in the future. So we watch this, we look at the charts, we take the data that as it's coming in. We don't, at least I don't really pay attention to, oh, we're going into a recession, we're not going into a recession. You could justify either stance right now. So we just watch the data, watch the market, see how they're reacting. And that's personally how I handle these things. Also, we're above that 4.02% level. That's according to the RenMac research. this is when it starts to bite into corporate profits. If we can get back down under that 4.02% level, that might help the market. That's why the market likes lower interest rates. That could really help drive prices higher, but we're not there yet. We're actually going up with interest rates currently. This was updated a week ago, showing an increase in the longer term unemployed. And here is the latest reading of the earnings estimates going forward. And again, the takeaway from here is that we're going up and to the right. And that's what we want for earnings here, because that's ultimately what drives stock prices. And this is kind of interesting, where you tend to see the first half of a Republican year, it's up 1.1%, where the second half of the year tends to be negative. We'll have to see how that plays out. And the market cap of the Magnificent Seven, 33%. That's why we follow these. I have individual charts. Even though I don't participate in those stocks, I still watch them very closely. And we want to keep an eye on what's happening there because they're a third of the overall market cap. And then the valuations, this is what's concerning the market. And I have additional charts in the intermarket analysis video that also go through the valuation. But this is technology, media, and telecommunications. These are more the growth areas. And this is the combined PE ratio. And we're getting pretty expensive here. We're up well over 40 right now, where we look at the rest of the market and we're not as expensive. We're over 20, which could be considered expensive, but a lot less than what we're seeing in the growth areas. And the core PC inflation, we're going to get that in the upcoming week in Friday's session. They're actually showing the forecast as coming down a little bit here as far as inflation, and that could be positive for the market. And I've been talking about this in the daily video. We're finally seeing the 10 to the 3 month yield going back. It's no longer inverted. Now we'll have to see if it can stay regular or will it drop back and go inverted. And that's typically when we start the countdown to see, are we going to go into a recession? We finally saw the 10 to the 2 year a few months ago. It went back to being normal. Now we're seeing the 10 to the 3 month going back to normal. And you're probably going to hear a lot of talk of, okay, we're going into a recession now that it's gone back. We'll watch employment, we'll watch inflation, we'll just watch the market in our charts and see how the market ends up reacting to that. Then this is just some forecasts here. I don't forecast myself, but people love forecasts and they think there's some value to those. But this is how is the market going to react? What's the PE ratio going to be? And then what's the target for the S&P when you compare the earnings? And this is the bullish case. And see, we're quite expensive here. We're up over that 20 level, but that would get us up to 7,400 for the S&P. The base case is that we'll be at about 6,500. The bearish case would mean the PE ratio drops down. But see, in both of these cases here, we're over that 20 level. So we're still considered expensive. But we've been there for a long time, where the bearish case would get us down to 4,600. Who knows if this is going to happen? These are just some projections that people make. Then FactSet did have some blog posts. This has to deal more with earnings. It says, are analysts cutting earnings per share estimates more than average? And then I wrote up here, the answer is no. And you can see that. So we're looking fairly healthy there as far as the earnings per share estimates. And then industry analysts predict the S&P will close above 6,600 in 2025. Look, you can come up with anything you want. I mean, how about 10,000 for the S&P? How about 2,000 for the S&P? Who knows? But they think that we'll initially start off with some weakness here and then look higher as we go throughout 2025. All right, then the analysts expect earnings growth of 9.5%. We're getting near the end of the quarter. After that is going to start earnings season, and they're looking fairly healthy, especially for the Magnificent Seven stocks. Those are the earnings that are really driving the market right now, and that's a pretty healthy return. All right, so here's the intraday chart where we ended up going down in Monday and Tuesday session, had a negative start, a little feeble attempt to bounce back up here, but then ended up closing down. Then we also saw probably the biggest decline, and we set the low for the week in Tuesday session. Then on Wednesday, we actually gapped higher and saw a bounce, but we really saw no improvement in the internal structure of the market that day. We were up, but nothing really changed. And what did change was very limited. Then in Thursday's session, we ended up going back down again. And then we started higher on Friday, went lower, and then ended up closing unchanged. So for the week, this is just the 5 trading days. We had the NASDAQ 100 and the NASDAQ. They're back, at least on as of Friday's close, back into leading the market right now. And that's helping the market to stay together at this point. When these areas do well, like they did last summer, that's when we see the S&P really performing well. We're a little bit concerned that the rest of the S&P and the rest of the market is seeing some more weakness here, but all the other sectors, or excuse me, all the other indexes ended up being down on the week. This is the year to date, where we still have the NASDAQ and NASDAQ 100. They're now back doing the best, where they had been lagging with the S&P here, because that's a combination. That's one reason I really like the S&P 500. It not only has the Magnificent Seven stocks and a lot of growth, it has more value as well. So it's more balanced, in my opinion. But all of the other indexes, when you look at this chart, we are positive on the year. So looking at the sectors just for the 5 trading days, since we had a down week, we had materials, they're getting hit pretty hard right now, and utilities, another defensive area, as well as healthcare. These were the areas that really had been doing a little bit better, but they're seeing some weakness now. And this is actually more positive in the bigger picture because these areas tend to be more defensive. We want the growth areas to do well. And you can see communication, discretionary, and tech. These are the areas that really drive prices up. If they're doing better, we're more positive on the market. And even though tech was down, they were down a lot less than some of the other areas where communication, was virtually unchanged here. And discretionary has been doing really well. When we had that really big down day in August, when everyone was sure that the end of the world was here, and that lasted what, a day or two, when the VIX really shot up and we had a big decline in the market. Since that day, discretionary has been the best performing sector in the whole market. And that includes Amazon, Tesla. With those stocks doing better, that also helps the market. Then just going over here to the right-hand side and ranking these particular sectors, we still have discretionary, which now is looking the best. And we're in the high 90s here. That's really strong. We want these to be in the 90s to be considered really strong, as well as communication and financials, even though they've been pulling back a little bit. And we'd like tech to do better. We're a bit concerned about semiconductors that I'll talk about here in just a moment as I go through the video. But these top areas, this is what really helps the market to go higher. And we like that the financials are hanging in there, even though they've been weak lately. Where energy, materials, and healthcare, they are the weakest areas of the market right now. So to a degree, the market has really shifted over to a growth stance, which if that ends up doing well, can really help the market to go up. And here are the sectors just for the week where we saw communication and discretionary positive, and that's what we like. Even though it was a down week, there could be some positioning coming in suggesting that we might be able to go up from here. But we have to work through the negative signs that we're seeing right now before that can happen. And I don't front run these things. We wait until we actually see confirmation because we don't know how long this will last. Then year to date, we still have communication, discretionary, financials. Tech is down just a little bit according to this measurement here, but these are the stronger areas of the market. And looking at the relative rotation graph where we have discretionary, it's coming on strong, one of the stronger areas. This goes back over the last year, and it can take a while for this chart to adjust. Financials are doing good, communication are doing good, and industrials doing good. We would like XLK, that's tech. It's showing an improvement here, but we would really like that to come over into the green area to be more positive. Now, here's the spreadsheet format where we have industrials, communication, financials, and discretionary. Those are the improving areas. Utilities, a little more neutral, and some of the weaker areas now, real estate, materials, staples, healthcare, the more defensive areas. And then the blue areas that are also showing some improvement, tech and energy, which is going up a little bit here. Then we look at just the indexes themselves. Transportation coming on. That's been a weaker, more frustrating area in 2024. That's showing some improvement. We'd like to see the mid caps coming on, the small caps showing an improvement, the NASDAQ 100, which this past week did pretty well, but we'd like that to continue to do better. And then the S&P is actually showing a little bit of weakness because there's more of a balance in the S&P. And utilities, which had been really strong, really long red tail here, showing how there's been a decrease in the utility sector. So we're seeing small caps and transportation showing some improvement. The more negative areas, the Dow Jones Composite Average, which is the Dow, the transports, and the utilities together, S&P 100, the S&P 500, the utilities, a bit of an improvement with the mid caps and the NASDAQ 100. As far as sentiment, the latest reading from Investors Intelligence came down a little bit. It was 3.91% a week ago. It's still 3.8, a little bit high. So there's maybe a little bit too exuberance going on in the market currently. But when you look at the gauges that I follow the most, we're right on the line. We're 50. You go above 50, that's positive. Go below 50, that's negative. So we're neutral according to this measure. And we've been kind of chopping around the 50 level lately. We tend to go with whatever this chart is doing. If it's going up, we're positive. If it's going down, we're negative until we get to an extreme positive or negative reading. Active asset managers getting a little too exuberant here too, and they tend to buy tops and sell bottoms, just like most investors do, because they have a lot of emotions and peer pressure to perform as well. And coming in at 99.24 on this chart, they're and maybe getting a little too positive about things. And we saw a bit of a tick up here with the VIX, with the line chart and the bar chart, but we've been coming down since the election where we were getting very high readings. We're getting lower readings for the most part, but with the down week that we saw, we did see the VIX going back up here. But seasonally, we tend to see the VIX declining during this part of the year. That means stocks are going up, but it doesn't mean we go straight down. You can see this is choppy down. So there are periods of time when there could be some weakness, and that's kind of what we saw this past week. We're just wondering how much more that's going to continue. This is still positive. When the black line is going down, that means the tech sector is outperforming cash. RIDEX bear bull ratio getting a very low reading here. Folks are mostly bullish on that. When they get fearful is when this really spikes. Not getting too much of an extreme reading with the American Association of Individual Investors. Still positive since we're above zero, but not real exuberant at this time. The Ulcer Index still below its moving average. We're also seeing that on the daily chart. Not a lot of fear picking up that way, at least yet. Then we look at the spread between risky and not as risky bonds, and we're still getting very low readings here, meaning there's not a lot of fear. And this is that same chart, just going back to other times. Okay, bad things did happen after 2007. And then this is going into the dot-com boom and ultimate bust. Is something like that going to develop? We don't know at this point, but we want to keep an eye on this. But for the time being, there's just not a lot of fear as measured by this chart. And then this is an inverse of that same chart. I follow this every day. I match it up with the S&P, and then I flip the VIX upside down too, just to get some different perspective on this. And we're just not seeing a lot of fear, but that could change at some point. And then we look at the VIX and then a 3-month average of the VIX, and that's continuing to go down, and that tends to be more positive in this kind of an environment. We're still declining for the most part with the 253 period equity put call ratio chart, and that's positive. When we're going up, that's negative. We continue to decline here. And then the latest reading of the National Financial Conditions Index, still below the black line. Not seeing any real fear here. Latest reading from GDP Now. We are going to get another reading of GDP in the upcoming week, but it's the third estimate. And we've seen that number twice now. So unless it's drastically different than the first two, it may not have much of an impact on the market. Coming in up over 3% with what they're anticipating here. And the forecasts are about 2.5% to the upside and about 1.5% to the downside. This also is looking positive here. If these start to turn negative, that means that we're possibly going into a recession, and we're not seeing that at least yet. This was updated a week ago. Just we're below this red line here in the latest reading. So after we had come up and gone above the red line, that's a bit of a concern. And that can indicate that we may go into a recession, but now we're starting to come back down. Also, still below this black line here with the smooth U.S. recession probabilities. This was updated a week ago. Brave Butters, Kelly leading index. This is a quarterly report, so it doesn't update all that often, but it's coming down. And then we will get an adjustment in the upcoming week with the core PCE coming out and PCE, where this week we did get CPI that came out here, and it bumped up just a little bit here as far as inflation. And there's a 96% chance that the Fed's going to cut rates 25 basis points when they make their announcement on the 18th, which will be Wednesday. And they pretty much have locked that in now, and that's become more what the market is anticipating. And then looking out to the January 29th meeting, they think right now anyway that there's not going to be any change in interest rates. If we cut them 25 basis points at this meeting, that'll put us to 4.25 to 4.5. And they expect it will still be at 4.25 to 4.5 after this upcoming meeting. So they may pause cutting rates. And the market's getting a little more convinced that's what may happen. But this could change and change quickly. Here's the Fed balance sheet, just showing the decrease that's been taking place here. And this is the year-over-year change where it's also declining even though the chart's going up. The overnight reverse repurchase agreements, not really seeing any kind of a change here. We just watch this to see if there's some kind of drastic move one way or the other, and there's currently not. So looking at our charts here with the advanced decline based on price, we are coming down, but we're still well above an advancing moving average. So this is still looking quite positive, and this is one of the internal measures that we look at here. We're also looking positive when we base this around volume. We are seeing a little bit of a concern here. We're seeing some weakness in the daily charts. This is another internal measure. Not much of a new expansion of new highs and a little bit of an expansion of new lows. We're going down with the 4-week and 10-week moving averages here, and we're actually declining on the daily charts as well. Coming down, but still positive with the advanced decline ratio. On the daily charts, we're actually dropping below zero with both the blue line and the red line. Turning negative here on the daily chart with accumulation distribution, where we're just pulling back here and still looking quite positive. This is a smart money indicator. The trend just shows that we are establishing a new longer term trend. We're above the moving average and going up, and we're positive since the green line's on top. We're still positive on the daily chart, but the ADX is right on top of the moving average right now as the market's just been kind of floundering. The Arun indicator is still positive. We're above zero and going up. So that shows that there's more buyers than sellers. No signal being generated by the mass index right now. And just kind of chopping around. Not really much action this past week here on the daily chart. And we were above average on a few days, and they were down days. That's a little bit of a concern. But then we dropped to below average later in the week. So in the short term, the mid caps and small caps are now negative, where the rest of the indexes that we follow are positive on all time frames. And bonds are negative based on price in the short and intermediate term. We've switched back to positive with commodities, where they're still negative in the intermediate and long term. Still positive across the board with the decision point scorecard. This is something I've been pointing out in the daily video. This is a long-term trend channel, and we're hitting the upper end of this. We're wondering if that's providing some kind of overhead resistance. Now, we broke above this before, like back in 2021. We're wondering, are we going to be able to break above that again? We're still looking positive here. We're above the 50-week moving average, and price is above both, and both are going up. And still looking good here with the moving average crossover, well above the 13-week moving average, even with the slight decline. Still looking good here with the pivot points. This is encouraging though. And if you pause the video and look at this, this is the McClellan oscillator. And you see when we got down to negative readings, look at what happened after that. And quite often it's positive. So this might suggest that there's some kind of a setup to an upward move that could last a little while here. It's not for sure, it's not a given, but there are times now, and we still could go down more with this before we actually get to some kind of a bottom and then start to go up. But this could be seen as a longer term positive setup unless something comes in to keep this line continuing to go down. And we are declining, but still positive with the summation index based on price and volume. We're still above zero with both. And we're seeing some weakness here. And we're weak on the daily chart also with the Swenlin trading oscillator. We're below zero and declining based on price and volume. This is also more negative in the shorter term, the bullish percent index. It's still positive since it's above 50, but we're declining both here on the weekly chart, and we're also seeing this on the daily chart. And the momentum on the daily charts is starting to suffer as we've been chopping around sideways and seeing a bit of a decline. Where we're looking a little more positive here with the PMO, with the weekly chart, and we're still above zero with price and volume longer term. And we're still positive since we're above the midpoint with the percent B indicator and still getting a good solid reading here, but not too extreme. And we're seeing the same thing here on the daily chart. The PMOs that are rising, we're starting to get to an extreme negative reading. And you can see other times when that happened, that was pretty good at setting up some kind of a low in the market. Now, it's not. You can't just assume this will happen. And we don't know if we're finished with this yet. But this could end up being positive as it plays out. But for right now, we're still declining with the buy signals, and the PMOs that are above zero are still going down. And here's the momentum with the slope oscillator. It's actually looking more positive. We're pretty much flat with the TSI, still going up with our intermediate term oscillators, and we're looking more positive with the long-term oscillators. Where on the daily chart, we're seeing some weakness pretty much across the board, except for the longer term here. And we're turning negative on the daily chart with the chicken money flow. This is still looking positive here on the weekly chart. So it could be more short-term problems. But longer term, this is still holding up. And we're negative on the daily chart with the Chaikin oscillator. We're coming down just a little bit, but still looking quite positive. The force index is declining here, but still positive. And Stoke RSI, after getting extreme positive, is coming down, but still above the midpoint. Also, still above 50 with the RSI. Also above 50 with the money flow. Wins percent are still suggesting the longer term momentum is positive. Ultimate oscillator still above 50 as well. So we're still hanging in there longer term. This is a little bit of a concern with the vortex. The green line is starting to get a little extreme. Now, we're positive on the daily chart, but the green line's really coming down as the red line's been going up. But here we're looking much more positive. But we might be getting a little too positive with this chart. Rate of change, we ended up having a slight down week. That's why we declined here. Still looking good when we go back 50 weeks, though. You copy curve turning just a little bit negative on the daily chart, where we're still positive here on the weekly chart. We're still positive here with the special K weekly chart, crossing above the longer term moving average here. And even with the decline, we're not even close to any of these pretty big support levels right now. So we are still positive on the weekly chart here with the Heikin Ashi, where we're seeing a mixed picture with our different trend measurements on the daily charts. We're positive with the Kegi chart, positive with the Renko chart, and positive with the three-line break. No X's or O's drawn right now. We see many more X's going up, and we see this blue line down here. So this is still looking positive. Still above the midpoint with a 14-week ease of movement, and we're coming down, but still positive on the daily chart. Momentum holding up fairly well in the long term. A little bit of a decline here in the intermediate term, and with the down week, seeing a bit of a short-term decline with the momentum. And we did set a new cycle right around Halloween, which for the most part seems to be going up since that time, but I don't base decisions around this. We've gone from positive to neutral with the Elder's Impulse system. We're still positive with the Parabolic SAR, where we've now turned negative on the daily charts. And I'm not sure why this is here again, in case you didn't get it the last time. Okay, looking at the different indexes coming off of an all-time high a week ago with the S&P, seeing some weakness here with the mid caps and the small caps over the past couple of weeks. And the Dow, though, is still looking quite positive here. We're still well above the 13-week moving average. The Nasdaq setting an all-time high this past week. It's under 20,000 now, but it was able to get above it throughout the week, but it closed down below it. Nasdaq 100 also looking pretty solid and up 0.73% for the week and setting a new all-time high here with the QQQs, which is the Nasdaq 100. The mid caps showing some weakness right now, but still above this longer-term trend line. Small caps also showing some weakness, but could be still holding up. The NYSE coming down to the 13-week moving average here. That may end up providing support. If we fall below that, that could be more of a concern. All stocks still looking pretty solid here. The FANG index setting an all-time high. And these are the big stocks. The Facebook, Apple, Amazon, Netflix, Google, Nvidia. These are what, at least for right now, what are driving the market to go higher. And as long as they remain more positive, that helps the overall market. Big software companies still looking much improved. ARC was down 2.5%, but it's been improving lately. The Wilshire 5000 coming, this is a daily chart, just coming off of setting a recent all-time high, but pulling back now. The bank index has been pulling back a little bit, and we were getting extreme here with the RSI, and now that could be coming down as we're seeing a little bit of profit taking, but longer term, the momentum is still positive. This is traditional Dow theory, where the Dow set an all-time high a week ago, and it ended up being down this week. Seeing some pullback here with the transports and utilities have been showing some weakness as well lately. And here we are in December, where we're up 80% of the time going back to 2020 with a return of 1.4%. That's right down here at the bottom. And looking a little bit better here with the commodities, where they've been kind of chopping around sideways lately. And this is the weekly chart. Oil still in the 70s area. It's just been kind of going sideways, even with all the crazy geopolitical things that are happening. And gold, after really going up and setting an all-time high, has been pulling back, but still in an uptrend. And the same thing with silver. Went up, came back, but still in an uptrend. The dollar's been doing quite well lately, and we're setting a new positive trend on the daily chart and here on the weekly chart. And copper still in a longer term uptrend. That suggests the economy is still looking good at this point. And here's the bonds based on price. Seeing a little bit of weakness as interest rates have been going back up. We're underneath the 50-day moving average, 13-week moving average, but still above the 50-week moving average. Stock to bond ratio is continuing to show on the monthly chart how stocks are outperforming. And after going back up and then pulling back, this is when the market tended to do better when we were coming down. Now interest rates are starting to go back up. There's a weekly chart where we're kind of coming down a little bit here with the US, UK rates as well as German rates, and we're declining a bit with the Japanese rates. And let's see. Okay, then looking at the intermarket analysis chart, we still are seeing stocks just slightly edging out gold as the best performing area year to date. Green, that's the dollar, and then red is oil, where bonds based on price are still negative year to date. So we look at a ratio between the Nasdaq 100 and the S&P, and both are doing really well, but this is when the market really performs nicely. You can see this run up that we had earlier in the year. That's when the market was just skyrocketing up. And we're seeing that potentially looking better here, even though we're still in a longer term downtrend with this ratio. The S&P 100 really improving compared to the rest of the S&P. In growth versus value, we want growth to do better in a positive environment, and we're seeing a real improvement here. And gold S&P just pretty much chopping sideways, even though gold is in an uptrend in this ratio. And this is gold to the dollar, where gold has been under a little bit of pressure lately, where the dollar's been going back up. And this also shows longer term how bonds are underperforming stocks with this ratio. Low volatility to the S&P 500. We want this to go down if we're more positive on the market. Back in 2022, when the market ran into problems, this ratio was going up. The fact that this is going down is more positive for the market. Discretionary to staples really improving here. That's what we want to see. Energy to tech, we show that energy is underperforming tech, and that's also more positive. Back in 2022, energy was outperforming, and the market was really having some difficulties that year. Then we look at another ratio between small caps and the tech sector, just showing how the tech sector is continuing to outperform. The small caps, at least yet, haven't really kicked into gear. The market's pretty much anticipating that's what's going to happen. So don't be surprised if something different ends up happening. Then longer term with the NYC breadth thrust, not any real changes here. We've been pulling back as the market's been under some pressure. Also, no new signals with the swag NYC breadth thrust. Longer term, going back to the 1987 crash, still looking good here. This is a further breakout of that same chart. Still looking good on this chart. We did a week ago get a full-on Zohorchak method buy signal after it dropped down to 8. It's now gone back up to 10. That's also longer term positive. NASDAQ 100 still looking good going back to 2009, setting all-time highs. The NASDAQ to Dow ratio coming back above this red line again here. That's positive. And the Qs to small caps also showing a real improvement here. And the new highs, new lows on the NYSE coming down a little bit as the market's been under pressure, but we're still well above zero. And this is a daily chart. And then we look at the same thing with the S&P 500, a daily chart, seeing some weakness lately, but still well above zero. And we keep an eye on the 3-month yield here as it's been coming down. We want to see is something like 2007 into 2008 starting to develop. So far, no, we're not seeing that. We're not getting a lot of warning signs, but we always keep an ear open just in case things do change. The new highs, new lows on a cumulative basis for the NASDAQ continue to improve. And then we have this Hindenburg moment. We have until, what is it, Thursday, when we'll need to see another spike here by December 19th. If that doesn't happen, then this goes away. And of course, the perma bears, they think this is a done, put a fork in it. We're crashing down from here. But according to the real rules of how this is used, we have to see another spike here within the 20 trading days of the first spike, and we haven't seen that yet. Then have a number of different seasonality charts, just suggesting that things are positive. We were up 5% in November. That's a good sign for December. December is rarely the worst month of the year. It tends to be one of the best performing months. And here's also another positive seasonality chart. This also shows how December is positive, going back to 1964. Then we look at November through April, which tends to be the stronger period for the stock market. This also is a seasonal chart going back to 1950, how things look positive from a seasonal basis. But this is no guarantee. But historically, this is what has happened before. And then we look at the monthly returns going back to 1950, where we tend to be positive in December. We look at based on a world perspective here, where December is also positive. Then we look at going back to 1928 during the fourth year of a presidential cycle, where both November and December are positive. And then here, November through January, also positive. So a lot of different perspectives here to show you. And then this is taking the whole quarter together, where that tends to be one of the better quarters. And we're coming into the second half of December now, which is also one of the better performing parts of the year. This also shows, according to Carson, from 1950 during an election year where things look more positive. And then we were supposed to have a more difficult time in September and October. It really didn't play out that way, but we're still seeing at least the potential for things being positive through the November, December period. And this is just different ways of measuring things in December, and they're positive no matter how you look at them. This is a newer chart here, which says Santa comes later in December. We're starting to get into that time now where we see more positive seasonality. And then this is looking out into 2025. This is what Trump 2.0, this is how the market has performed so far, and then what's likely to happen going through 2025. And this also shows a pretty positive time for December, not only for the S&P, but other indexes. And this also shows that the S&P is up 15 out of 18 times and down 3 out of 18 times going back to 1950 with a return of 1.3%. So thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.